In January alone, Microsoft, Google, Meta, and other tech companies have slashed more than 21,000 jobs. And last year marked one of the worst in recent memories, with 260,000 techies losing their jobs. Typically, we should see cost-cutting measures like retrenchment during a contraction stage, like what we see those in the dot-com bust. And not when the market is in its growth stage like today. So what is happening? My name is Kon Hao. My work in this channel, as always, is to study behavior science and finance, discover correlations between different markets, and uncover potential opportunities. And before we discuss about this subject, please do take some time to read into the disclaimer. Let's do a recap on the dot-com bubble and its crash and its retrenchment compared to today's AI bubble and its retrenchment. And we have to understand that in every economy and business cycle, there are typically 4 stages. And I call it as the formative years, the trigger, the growth, and the contraction. And then the cycle complete, and it may move into another cycle like this. And what happened to the dot-com bubble and its burst? It was during the 90s. We all have dreams that one day the online shopping will take place. So that was the formative years. And then comes in 1995, we have the birth of eBay, and that caused a trigger. And this was the hope coming to reality, but this hope brought us to a hype, a euphoria. It didn't really take place in a big way for the online shopping, but there's just simply so much hype during the dot-com bubble, and it literally caused a euphoria stage that we saw here with a technical correction. Started with an inverted hammer, then the contraction comes. And of course, with the downfall of the dot-com bubble to its crash, many companies back then, the tech companies are no longer around. And the existing one back then also did a massive retrenchment. And that was a good thing because it cut down the cost for the companies to heal itself, that get into the formative years. And this formative years that we could see that lead us to 2004, 2009. And the online shopping dream is still hanging on. That was crossing over, passing to the millennium. And then there was a trigger. And that was a real trigger because it was during the time in 2011 where Alibaba tied up with PayPal, and that for the first time online shopping in a B2B manner it take place. And this was the real growth. And we saw this. The online shopping finally took place after 2011. And this was a real growth. And coupled with EV hype and now AI hype is a new thing. I saw that EV hype already crashed, but we have an AI hype that brought us to the extreme high, and it could be at its euphoria stage. Now the thing is that compared to then, there is a divergence between the stock prices and the company action. So earlier we discussed about retrenchment comes during the contraction stage, but now retrenchment is taking place at its growth stage. So one of the reason for this massive retrenchment is to increase the company's profit. With lesser overhead payout, more will be going into the company's balance sheet, thereby increasing its net profit. And this is what I call a divergence between the stock prices and the company's action. And I got a little bit of suspicious here, and I'm still buying into the US stocks, but I remain very cautious. Now let's take a look at what happened to the US market. And we could see that over the years, since the dot-com bust, and we literally saw that the US tech stock has been trending up in a very nice manner because of this growth stage. But I do suspect that because of this divergence, perhaps we have to be, as investors and traders, we have to be always very inquisitive. Could it be we're entering into a double top? That's one possibility. Now, the other possibility is that as I'm became very cautious right now, I'm still buying on dips in the US market because technically it's still showing me that it's moving up. But in the same time, I have to take every movement as some clue to me. So what I saw was as the market going up, maybe I'm just going to blow this up a little bit here, that I saw that there was inverted hammer, just like what we saw those before the dot-com crashed. And this week, we have one more trading days to go, and this is a weekly chart. If it ever close here, it could be a mini double top that we're seeing here. And that's why I call an inverted double fork. And could this send the market down? And definitely because of this formation, I'm not keen to buy in the US stock at this point in time, but I do not mind to take some profit and perhaps turn short. Last week we discussed about the price and volume divergence, and today we explored into the deviation between the stock prices and the company's action. This is another form of divergence. Market opportunities are always around. We just have to stay vigilant on which side they are heading towards. Stay tuned for my coming tutorial. Remember to subscribe to my channel. The market are always telling us on their next move. Join us in our weekly case study and discussion. Click on my profile icon to find out more. Feel free to leave any comments below. I love to exchange ideas with you. Really happy that you stayed through this tutorial. You have many great trading weeks ahead.